Okay, what's going on, everybody? Welcome to a Capital Hungry Monday Market Update webinar. Let me know if everything is clear with the audio and visual. I brought the webcam today right in front of me. You guys can see my hand motions pointing at the chart, pointing over here. Is everything good with the audio and visuals? You should just see an empty gold screen right now. My video, as well as just the Capital Hungry banner. Okay, sweet. I just wanted to make sure because it's my first time adding the webcam in. Everybody wanted the webcam, so I just put a small one in the corner there so you can see me. Oh, sorry, I just ate some food. Okay, everybody, let's jump right into it then, shall we? Welcome to the Capital Hungry Monday Market Update webinar. So basically, through the next 30 to 40 minutes, we're going to be... No, I'm still using the same mic here. The audio is all the same. Should be the same. Is there an issue with the audio? Let me know, guys, before I start talking and ranting too much. Is there an issue with the audio? Is it not clear? Okay, sweet. Okay, cool. All right, cool. I'll move the mic a little bit closer to me. All right, welcome to the Capital Hungry Monday Market Update webinar. Through the next 30 to 40 minutes, we're going to be breaking down fundamentals, technicals, and some trade ideas on gold, GBPJPY, GBPUSD, EURUSD, USD Cad, and US 30 stock market index. Let's jump in here with some of the recent fundamental points. We can still see that US dollar bulls are very active at new intraday highs. We haven't really had any new fear, uncertainty, and doubt with the Russia and Ukraine tensions, but we're starting to see that bubble up again. We can see global inflation becoming a higher risk as global inflation and CPI figures as well as PPI figures are still very high. Equity seeing some short-term weakness or just some intraday ranging with some more hawkish central banks. And overall, what's in focus this week is going to be CPI and PMI data from various regions. Okay? In terms of market sentiment, we're still looking to play US dollar bullish bias. We're still looking to play Japanese yen individual weakness. And we're still looking to play some of the bulls in the equity markets, but just understanding we're having some more intraday indecision and ranging. All right. Market volume and volatility, just to start off the week, has been a little bit lower and slower. But as we're coming off the Easter holiday from Friday for the North American regions, and of course the Easter Monday for European regions, this was very much well expected that we would have lower volume and volatility. So that's something you want to stay adaptive to, especially when we're trading our currency pairs. Some notable headlines through the New York and North American trading session is that Ukraine's President Chief of Staff says the second phase of the war is starting, Russia's new Eastern assault. So even though we haven't seen any new fear, uncertainty, and doubt really rising in the market just yet, it does look like in the next couple of coming weeks or months, we will get these tensions escalating with the Russia invasion as we can see other countries, especially from NATO, start to get involved. Russian forces have begun the Battle of Donbass. So we can see that we're starting to get more headlines with Russia invading Ukraine, but what we need to actually have it have market impact is new events that have not been priced into the market yet, which we can potentially see with this assault escalating on the eastern front of Ukraine, and especially if other countries start to get involved from a military standpoint. Also, later through our North American trading session, we still had some Federal Reserve speakers talking relatively hawkish with expectations of 50 basis point rate hikes during our May meeting to come, the May interest rate decision, where obviously US consumer inflation and producer inflation is through the roof. So the Feds have to take a more hawkish stance and a more aggressive stance to bring that inflation down. Now, in terms of market sentiment, we can see Japanese yen is still fundamentally and technically bearish. So we're still looking to play JPY buys, XXX JPY buys, where we primarily look at GBPJPY. The reason why Japanese yen has been so bearish is, unlike other central banks, because of Japan's economic structure and debt structure and how they are already in negative interest rates, they have been far less hawkish and are more on the dovish side compared to Bank of England, Bank of Canada, or the Federal Reserve. So we can see that confirmed with the previous weeks, where the Bank of Japan stated that they're still running an unlimited bond buying program at a specific fixed price, as well as they can still see USD JPY price going to 130 before they see any manual intervention or they look to raise interest rates. So that's keeping the Japanese yen individually very bearish, as we're breaking below 2008 historical lows as well as 2014 historical lows. And overall market structure and price action is bearish for that fundamental reason from Bank of Japan bond buying program and overall dovish stance. Make sense? You know what I mean? Now you guys can actually see me ask you, you know what I mean? Does it make sense? The US dollar, on the other hand, has been a lot more bullish for the inverse fundamental reasons. The US dollar, which is more correlated to the Federal Reserve Central Bank, where the Feds have been a lot more hawkish. They've started to stop their bond purchasing program and decrease their asset purchase program. They're starting to look at interest rate hikes and actually did that 25 basis point interest rate hike with expectations of a 50 basis point hike to come in the May meeting. You can even see when we had a higher CPI reading, it led to this downside move here on the US dollar from these intraday highs printed, but it was extremely short-lived, as right after the US CPI report, we had Fed speakers come in and start playing damage control, talking about how they're going to be a lot more aggressive with their monetary policy tightening and their overall hawkish stance towards the markets. This is keeping the US dollar relatively bullish, but the Fed's hawkish stance on the markets and the expectations of a 50 basis point rate hike is keeping the equity markets more in a intraday range here when we're looking at the US stock market. The reason for this is obviously greedy stock market buyers want to try to squeeze out as much as they can, with inflation still being high, riding the wave of low interest rates, high inflation, and the support of the central bank. But as the Feds are decreasing their asset purchase program, offloading off of their balance sheet and decreasing their balance sheet, as well as looking to increase interest rates, this makes the conditions to be buying into the stock market no longer as favorable. So on the intraday time frames, you can see we've been in a very heavy indecisive range, which I'll explain in some more detail. Overall, our equity markets, besides US 30 being a bit more flat, our equity markets are still holding relatively bullish. So that investor confidence is still within the risky investments, whether it's your equities or whether it's your risk currencies like GBP or Euro, especially against a weaker Japanese yen or a weaker Swiss franc. The US dollar is a whole different story. I'm still expecting downside on any of our pairs against the dollar, like GBPUSD or EURUSD. Okay? So in terms of market sentiment, we still have that dollar strength, Japanese yen weakness, and even though equities are ranging, as we're starting to see the liquidity in the equity markets drop a little bit, we're still just sitting at those high points on the higher time frame. We can see that further correlated with the volatility index just in an intraday range, but still respecting overall bearish market structure, showing us the fear, uncertainty, and doubt within the US equity markets is still relatively low. Okay? So keep in mind those fundamental points of what's in focus, a lot of the inflation figures and PMI figures. Keep in mind we're starting to see Russia tensions come back into the table, but nothing too serious just yet that's actually having a detrimental market impact. And also US dollar bulls, we're still looking to take advantage of that. These are some headlines that support some of the fundamental catalysts we are talking about, and we just went through market sentiment. Now, before we jump in our technical and fundamental trade ideas across the board here, as manual retail traders, whether you are a scalper or a day trader, you want to have a good understanding of what economic events you have on your schedule that can be impacting what you're trading. Luckily for us, we don't have too much going on from an economic data standpoint perspective until really later in the week, where we have a lot more CPI figures, inflation figures, and PMI figures from regions across the world, the Eurozone, US, Asia, you name it. But what we have going on. Okay, so through our Asian session, not too much going on here, or overnight. We don't have too much going on at all. At 8:15 a.m. Eastern, if we're trading USD Cad, it's not going to have too much of an impact at all, but we do have some housing starts data from CAD here that's going to be impacting the Canadian dollar. At 8:30 a.m. Eastern, we have some housing data and building permits data for the US. Honestly, this building permits data and housing data, it's probably going to have minimal impact to no impact at all. So there's really not much going on from an economic data perspective when you're looking there. You know what I mean? Oh. And other than that, nothing going on over the London or Euro session. Very quiet during the New York session. Then during Asian session tomorrow, we have some import and export data from Japan, which is going to impact the Japanese yen. So in terms of volume and volatility, as we're just coming off of a holiday and we have a start of the new weekly period with very minimal economic event catalysts, if we don't really get any new fear, uncertainty, and doubt coming in from some reactive headlines, make sure you guys check out Capital Hungry News Twitter for your best news resources there. Forex Factory, all those websites, be sourcing from there. But if we don't get any new fundamental catalysts or some new escalations with the Russia tensions, I'm personally expecting some relatively quiet movement with volume and volatility. Okay? Now that we've gone through the fundamental points in focus, market sentiment, understanding some of our analysis of our market sentiment indicators, what economic events we have in the docket, now we can take all that information and do some technical and fundamental analysis across the board here. So when we've been looking at gold here, for anybody who's been following along, we've been looking at some very similar technical repetition to this situation here, where we had a large impulsive upside move and rally, a pretty equal correction that did not break bullish market structure or did not break a very key higher time frame demand zone, which we can also see here. Then you can see as we have the impulsive moves get priced in, very large correction that's equal to the size of the impulsive move. No break of bullish market structure, we enter a consolidation phase for an extended period of time. Once we start breaking out of that consolidation phase, we can see some nice extended upside plays to the previous highs. That's what we were looking at over the last couple of weeks. And if you've been following along previous free market update webinars or live analysis done on this YouTube channel, you can see it's playing out beautifully, right? We're seeing a nice breakout of the range, respecting overall bullish market structure. Fundamentally, even though the Federal Reserve is becoming a bit more hawkish, it's not just the Federal Reserve that impacts gold. Gold is a global, traded, hoarded, used in industry, used in electronics, mined, produced, global precious metal safe haven, right? Obviously, when there's not much going on from a fundamental catalyst perspective, you're going to have what the Feds are doing hold a bit more weight. But because global inflation is so high and we don't have all central banks on the hawkish side, where the Euro Central Bank and Bank of Japan are still relatively dovish, we're still having gold bullish because of global inflation so high, as well as lingering tensions, with Russia and Ukraine. On top of that, in my opinion, if we start to see a downside move on the US stock market and equity markets, right? If we start to see equities go down and we start to see a bit of a correction on the stock markets and a bear market enter the scene, more than likely we're just going to see liquidity and order flow go from an outflow in equities and inflow into gold, which is a very similar situation we had happen here when we had first a lot of fear, uncertainty, and doubt. You can see when gold exploded to previous all-time highs at 2075, it was the same time that Russia and Ukraine tensions were coming into the table, and it was the same time Feds were introducing the interest rate hikes to come, and you saw the stock market enter this very aggressive dip. You literally see buyers liquidate positions from the stock market, have that exit liquidity and liquidate their buy orders, and have that go back into gold, where the same time period here from about February and into March, where you actually have the downside move on the equity markets, you can see on gold here from about February into March, you have that liquidity exit out of the stock markets and a huge inflow in gold. Investors hedge the risk that's coming with Ukraine and Russia tensions, as well as US rates rising, by taking that money out of the stock markets and pooling it into gold. So we had that huge impulsive move and correction. And also, look at this, which is extremely interesting. The same time you had gold peak these all-time highs that was created from the pandemic here, almost surgically on a dime at that exact same price point of interest around mid-March, right? And you see that exit of buyer order flow and a very heavy pullback created, but still bullish market structure. The same time you see that is the same time you see a dip get created on the stock market and a buy bounce into the stock market. So what I'm potentially seeing in terms of liquidity and how smart money and market makers can potentially adjust their order flow is that if we start to see equity markets drive back down to these lows, what we can assume and anticipate is there's going to be a higher probability of that liquidity entering gold as a hedge against that risk, right? So with global inflation still high, expecting high inflation figures to come as well, we have some very nice intraday bullish market structure being created here. On the intraday time frames, even removing the key levels for those fundamental reasons stated, from that demand zone, we're having buyers consistently print higher highs. From these higher highs, as buyers peak these new intraday highs, you can see we enter these minor corrective pullback phases, which end up just being some short-lived corrections, as we have buyers liquidating positions on the intraday time frames. It creates a short-term pullback phase as sellers jump in, providing that exit liquidity, pushing price down to a more favorable demand zone and demanded price point for buy orders to be collected again, driving back up to those highs and potentially higher highs, right? Higher highs printed by buyers, pullback phase to a more favorable demand zone, extending back up. Higher highs printed by buyers, pullback phase to a more favorable demand zone, extending back up, right? So when we're looking at gold here, our first significant retest area is around these previous highs, which is going to roughly line up with a 1976 key level, or we're going to be seeing if we get deeper pullback plays where we can come down to 1965 before seeing some potential buy bounces. So these are the trade ideas I'm personally looking for on gold on the intraday time frames. Now, if we come down to 1972, fail to break, buys back to the upside. Break above 1981, continuation buys. Playing the bullish market structure, bullish price action, high global inflation, uncertainty and doubt with Russia tensions still lingering. I would personally only sell gold if we came back below 1965, and those would be some short-term pullback sells where I'd expect us to have deeper retests of that bullish market structure and then still expectations of higher time frame buys back to the upside. Okay? So overall, because of the higher time frame bullish market structure, bullish price action, fear, uncertainty, and doubt starting to develop with Russia and Ukraine, starting to see equity markets soften a bit with buyers potentially liquidating positions, and still having globally high inflation, all we can see is we're expecting some minor pullbacks of support to be created and extending back up the key levels. And I'd only sell if we broke below these previous lows to the left, key level 1965, where that would be a short-lived counter trend trade sell to really just set up better risk versus reward buys. Because you have to understand, it's very normal for the beast precious metal like gold, where when you peak new highs or you potentially don't break previous highs, you can enter a pullback phase. These pullback phases can be hundreds of pips, and they'll go to retest previous demand zones or retest of structure, and it doesn't break the overall structure. It doesn't show that sellers are in control, but it's the way we analyze the market waves based on the buyers and sellers transactions happening behind the scenes, right? So even when you're looking at gold here, obviously we want to see just a bounce off 72 or 81, but when you're looking at the way gold behaves, if we have a deeper pullback to 53, it still wouldn't be out of the ordinary. All we're seeing right now is buyers again peak a new high point so far and seeing some profit taking from those highs as we're now just entering that pullback phase. We're going to analyze that pullback phase based on lower time frame structure and price action. As soon as we can identify the sellers exhausting out and that support being created at a key level or retest of structure, it is very, very easy to start jumping back in with the trend, expecting us to revisit the previous highs and also extend up higher. The ideology behind this is because you have so many market participants and a lot of the market trading is algorithmic and automated, you're having transactions enter the market every millisecond. You're having transactions enter the market every minute, every hour. Buyers and sellers exchanging orders back and forth around the clock from institutions around the scene. This is what creates these market waves. But the ideology is most of these pullbacks are just price being pushed down to a more favorable demand zone so you can collect more buyer volume to extend up and continue the overall bullish trend. Right? So what would be ideal is us pretty much starting to trend back up to those previous highs into the 2050s and 2075s. But again, right now, quick pop quiz to who's paying attention. Right now, when you're looking at gold, what phase is it in? Even though we're very bullish, even though we're having buyers print higher highs, right now, since the start of the new weekly period, what phase is gold in? I'm just going to give a quick 3 seconds to the chat. In a pullback corrective structure, right? Seeing some profit taking from a new intraday high. Exactly. Now, based on price action and market structure, if we don't get the full pullback to 1972, if we just have a pullback that's retesting these candle body highs and we come back above 1981, I would still be looking for the buys there. Okay, everybody? Hopefully you guys enjoy that analysis on gold. I'm trying to be as in-depth and informative as possible, but I have to keep these pretty short and sweet. Otherwise, it's going to end up being 2-3 hours long. So you can always re-watch this, you know what I mean, as you wish. Now, GBPJPY. You don't need to be a rocket science to understand with the individual weakness in the Japanese yen due to the Bank of Japan's unlimited bond buying program, the Japanese yen, as already explained, is extremely bearish, right? But then we have the Bank of England, which is the central bank for obviously the United Kingdom. The Bank of England's more hawkish. They've started to raise interest rates. They're talking about raising more interest rates in the near future. So this gives us some nice one-sided volatility of GBP strength and JPY weakness from a fundamental perspective. On top of that, we're breaking above previous intraday highs, and on the higher time frame, we're still having that same historical repetition from these higher time frame demand zone lows. Where now, especially as we're breaking above some of this higher time frame bearish market structure, where this was the 2008 financial crash, this was Brexit, this was the pandemic down here. None of that has ever been enough to break this demand zone, which just sets up better buys for the institutions from those historical lows. And we're having very similar technical repetition to what we've seen from this previous rally, with a lot of potential to keep continuing bullish here on GBPJPY from both a fundamental perspective and a technical historical repetition perspective. Right? I know I make it look so nice and simple. So on GJ, what we can also see, this is the 4-hour chart, is beautiful intraday bullish market structure. Also breaking above these previous intraday highs. Now, we're seeing the same idea. Buyers consistently print higher highs, and then you just enter some short-lived corrective phases. This corrective phase can either be a short-lived consolidation zone, or of course a pullback that goes to retest previous price sensitivity areas before having enough buyer volume to continue back up with the overall bullish trend. What we're seeing here is GJ had a pullback, went to revisit previous highs here, almost lining up with the wick previous high price sensitivity area, and starting to see a lot more continued bullish momentum. I do just want to expect some minor pullbacks on GJ and continued buys. Let me show you guys now, more zoomed in. Okay, so GJ starting to show us a lot more life as we had buyers peak these highs, a minor pullback phase to the previous highs here, a support created in technical double bottom, which shows us more buy orders being collected, now showing us some more volume with the safer buys being above 165.5. On GBPJPY, I would be looking for pullbacks to 165, scaling above 165.2, buys above 165.5. Even if we came down to 0.800 again, all of these green boxes at the PPLs here, 164.8, 165, 165.5, based on lower time frame price action, I'd be looking for a support being created and continued buys. Basically, what I'm trying to visualize here is no different than this piece of market structure and situation here. Okay, let's break this down. Buyers have a nice bullish rally and peak a high point. From that high point, you have a little bit of corrective pullback structure as you have sellers jump in and buyers liquidate positions, coming down to a more favorable demand zone. As you come down to a more favorable demand zone and fail to break, you can see sellers exit out, buy orders being collected with a break and retest that goes to at least revisit the highs and break out higher. That's the same type of scenario from a technical repetition standpoint I'm looking for here, right? Because don't forget, Japanese yen individually is bearish. Price action bearish, fundamentally bearish, technically bearish, right? And when you're looking at our global equity markets, even though UK equity markets are a little bit flat from these highs, UK stock market is still very bullish. It shows us that the investor confidence is still relatively high there, right? So yeah, looking for those pullbacks, continuation buys. Now, very clear-cut understanding on gold and GBPJPY there. But our dollar pairs are a different beast. Even though GBP might be holding some strength against the Japanese yen, does that mean it will hold the same strength against the dollar? And if not, why? How come GBP is so bullish against the yen, but it's so bearish against the dollar? Pop quiz. Quick pop quiz in the live stream chat. Huh? How come GJ so bullish against the Japanese yen, but so GBP is so bullish against the Japanese yen, but why is it so bearish against the dollar? No, it's not divergence. It's not because dollar's just strong. It's because dollar is the global business currency. Remember, GBP is strong right now as well, right? GBP is also strong. We have Bank of England hawkish, Bank of England doing rate hikes. So why in GBPUSD, when both of these currencies are strong, right? So why is GBP so bearish if both of these currencies are strong? It's because the US dollar holds a lot more weight on a global scale as the global business currency, global reserve currency, right? So no matter what pair you're trading, even if the other currency is strong, dollar usually ends up dominating with its movement. Because the dollar's individually so bullish, and because it's the world business currency and reserve currency from an international business standpoint, we see that dominate when you're looking at GBPUSD or when you're looking at EURUSD here in terms of your structure, in terms of your price action, in terms of your order flow with sellers in control. Okay, so GBPUSD on the higher time frames is extremely bearish. All you're having is sellers consistently printing lower lows. You enter these pullback phases that are very short-lived for the intraday periods, and then you drive down back to the lows, potentially even lower. Right now, we're seeing a little bit of indecision as we're ranging at these lows, but GBPUSD is still extremely bearish the same time dollar is bullish. When I'm looking at GBPUSD here, what I would personally be looking for is if we can get a double top to 1.304 key level, which is a retest of these previous price sensitivity areas to the left and key level cells. Breaks below 1.30 flat, breaks below 1.2985. Also, if we do have fear, uncertainty, and doubt start to rise with Russia and Ukraine tensions, that's just going to bring some further strength to the US dollar and individual weakness to your basket of risk currencies like the British pound, euro, and so forth, right? So that would be further confluences for us to look for some GBP, USD, Euro USD sells. Euro USD is not going to be much different. The only thing different here is Euro is actually a lot weaker than GBP or the US dollar. The Euro Central Bank, which has a very similar setup to the Bank of Japan, is already in negative interest rate territory. And they're not looking to raise interest rates or stop their bond buying program or stop their money printer anytime soon. That still devalues the euro, especially against a stronger dollar, and especially against the dollar as the world reserve currency. So euro fundamentally is a lot more bearish. But when I'm looking at Euro USD, even if we get deeper pullbacks to 1.084, pullbacks to 1.079, and breaks above these lows at 1.077, it's still best to play the bearish price action and market structure. Strengthen the US dollar, hawkish Federal Reserve, dovish Euro Central Bank, weaker Eurozone economic data as well. Plus, if the Russia and Ukraine tensions continue to escalate, it's going to have a larger impact on Euro's economy rather than like the North American economy, obviously because of the closer ties there, right? And I do see Russia and Ukraine tensions coming back into the table over the next couple of weeks with some new fear, uncertainty, and doubt. Now, USD CAD here, as dollar strength is coming back into the table, we can obviously see that we had sellers fail to break these lows at 1.245 previous lows, which is also a weekly demand zone here. The Bank of Canada being more hawkish was a short-lived downside move, as even though the Bank of Canada is hawkish and the Canadian dollar has individual strength, that's still not going to overtake the strength of the US dollar because of the concept I'm telling you guys of the dollar being your world reserve currency and global business currency, correct? So it's getting a little bit messier here as we have that indecision, but we are starting to see some stronger bullish market structure being created. We just really need breaks above this price sensitivity area to see some continued buys. But nonetheless, even if we got a double bottom at 1.252, scaling back above 1.26, or buys above 1.266, I would still be looking for USD CAD buys. Dollar index extremely bullish. Bank of Canada move getting faded out with their 50 basis point rate hike and not having a long-term impact. Oil starting to see a little bit of a pullback from its highs, which is deflating the Canadian dollar in terms of that fundamental correlation. We're just having some slower volume and volatility as we're coming off of a holiday. You know what I mean? Last but not least, our US equity market. We're going to keep this very, very simple, short and sweet. No point fighting this intraday range here. As a scalper or day trader, if you're not taking your profit when you're buying at the bottom of the range at the top, or if you're selling at the top of the range and you're not taking your profit at the bottom, this can be extremely aggravating. It can be very stressful. It can bring you a lot of tension, exert your mental energy, and absolutely waste your time trading this range, okay? So in my opinion, if you're a equities trader and you're a scalper or day trader, don't exert your mental energy and capital trading these messier conditions, because as a manual retail trader, your psychology, your emotional control, how much mental energy and focus you have when you're coming to the charts is extremely important. And this can be very, very mentally draining. Any type of large intraday range for a scalper or day trader can be very mentally draining to trade. The price action on the lower time frames always a lot more messier. You have a lot more whipsaws and indecision between buyer and seller order flow. You can see some of these indecisive wicks as well. We're just going to keep this very simple from a technical perspective. If we break below 34,200, just look to sell, especially if we have more hawkish Federal Reserve holding below 34.3 and any new fear, uncertainty, and doubt with Russia and Ukraine. Otherwise, I only see safe buys above 35K flat. I do not want you wasting your capital fighting this intraday range and stressing out scalping this. You know what I mean? Because don't forget, as manual retail traders, what the most important thing is, having accurate analysis is one thing. Having confidence in your trading system and your strategy is another thing. They're of course very important. Developing your chart hours, developing your experience is of course very important. But what's most important is your trading psychology, your emotional control. How consistent and disciplined can you be with your logical decisions that you make? Are you making your decisions based on pre-planned analysis, based on risk, based on probabilities, or are you making your decisions based on impulsive emotional desires? It's night and day difference, right? All right, everybody. So through this 30 to 40 minutes, we went through key fundamental points that are, of course, impacting the financial markets in terms of some fundamental catalysts, economic events, and so forth. We went through analysis of market sentiment, US dollar, Japanese yen, looking at the volatility index and global equities as well. We did a quick analysis of our market volume and volatility. We went through some key headlines from the North American trading session. We went through what economic events we have on the table, as well as fundamental and technical analysis and trade ideas on gold, GJ, GBPUSD, EURUSD, USD Cad, and US30. I hope you guys enjoy these webinars. I hope you guys like me with my face showing here. I don't know why people wanted to see my face so badly, but I hope you guys enjoy these. You find them informative, you find them educational, you find them useful. And I'll see you guys Wednesday morning for the New York scalping session. I'll also be a lot more active on Raja streams, Wicks Don't Lie streams. All right, everybody? So have a great day. Have a great night. I'll see you guys all next time.